Last year, I shared my top AI ETF picks, and they delivered an average return of 26.8%. That's nearly double the S&P 500's performance. This year, I'm back with something even better. I'm going to reveal 8 ETFs that could position you perfectly for the AI revolution, plus my exact allocation strategy. But before we dive in, I need to be clear. I'm not a financial advisor. This isn't financial advice, and past performance never guarantees future results. This is purely educational content to help you research your own investments. Here's what makes this year different. Instead of just throwing ticker symbols at you, I'm giving you a complete framework. I call it the AI industrial stack, and it maps the entire life cycle of AI from raw energy to physical automation. Think of it like building a skyscraper. You need the foundation, the structure, the power systems, and finally, the intelligence that makes it all work. That's exactly how we're going to invest. Sikari. Layer 1. The foundation. Energy. Let's start at the bottom. AI isn't just code, it's electricity. The biggest constraint facing AI right now isn't silicon, it's power. These models need massive amounts of energy running 24/7, and that means we need nuclear. ETF number 1, Global X Uranium ETF, ticker URA. This is the premier way to invest in the global uranium supply chain. While everyone else is focused on the tech companies using electricity, URA invests in the companies generating it. You get exposure to the entire nuclear fuel cycle, from miners extracting uranium to component makers building reactors. What makes URA special is the balance. Its top holding is Cameco at 22%, which is the backbone of global uranium supply. But it also holds Oklo at 12% and Uranium Energy Corp at 6%, giving you that perfect mix of established players and innovative upstarts. The details: 50 companies, 0.69% expense ratio, 1.66% dividend yield, and a stunning 71.9% year-to-date return. Analysts forecast another 24% upside over the next 12 months. Now, I know what you're thinking. That expense ratio is high. And you're right, 0.69% is higher than your typical index fund. But here's my take. I'm not going to complain about paying 50 basis points more when the fund is delivering a 70% return. That's 50% better than the S&P 500. The performance speaks for itself. ETF number 2, VanEck Uranium and Nuclear ETF, ticker NUKZ. This one takes a broader approach. Unlike URA, which focuses heavily on miners, NUKZ pivots into utilities and grid companies that actually deliver power to data centers. You're buying the entire supply chain. It holds Cameco at 9% for raw fuel, but matches it with Constellation Energy at another 9%. That's the utility giant signing direct power deals with Amazon, Microsoft, and Google. It even captures the grid build-out with companies like GE Vernova and Quanta Services. The details: 46 companies, 0.85% expense ratio, no dividend currently, and a 60.7% year-to-date return. Analysts see 16.9% upside ahead. If you're getting value from this video, do me a quick favor and hit that like button. It helps the algorithm show this content to more people who need it. Layer 2, the infrastructure. Now we move up the stack to infrastructure. This is the physical shell housing all that intelligence. We're talking about the buildings, the cooling systems, and the grid keeping everything running. $2.8 trillion is flowing into this layer right now. ETF number 3, Global X Data Center REITs and Digital Infrastructure ETF, ticker DTCR. This is the pure play on the physical housing of AI. While chip makers get all the headlines, DTCR owns the buildings those chips live in. These are the companies building out massive facilities, managing power and cooling, and leasing rack space to Amazon, Google, and Microsoft. What makes DTCR unique is its concentration. It holds the 2 biggest data center landlords in the world, Equinix at 10.4% and Digital Realty at 9.7%. But it also captures high-performance compute plays like Applied Digital at 9%, which is up over 200% this year alone. The details: 26 companies, 0.5% expense ratio, 1.29% dividend yield, and a solid 28.25% year-to-date return. Analysts forecast 28.4% upside. ETF number 4, First Trust NASDAQ Clean Edge Smart Grid Infrastructure Index Fund, ticker GRID. If DTCR is the shell, then grid is the nervous system. This ETF targets the electrical infrastructure, keeping those data centers from going dark. We're talking substations, transformers, and energy management systems. Grid buys the picks and shovels of electricity. It holds industrial heavyweights like Schneider Electric at 8%, ABB at 8.2%, and Eaton at 7.1%. This is one of the most direct ways to invest in electrification without betting on a specific utility. The details: 114 companies, 0.56% expense ratio, 1.01% dividend yield, and a strong 29.22% year-to-date return. Analysts see 9.62% upside. Layer 3, the engine, compute. Now we get to the heart of the stack. This is where the actual thinking happens. $4.2 trillion is being spent on this layer, the chips and hyperscalers architecting the entire AI system. ETF number 5, VanEck Semiconductor ETF, ticker SMH. This is one of my absolute favorites. SMH is the undisputed engine of the AI revolution. It strips out software and cloud services to focus purely on the hardware training these models. This is the most direct way to own the silicon supply chain without picking a single winner. What makes SMH special is its concentration on industry leaders. You get NVIDIA at over 16%, Taiwan Semiconductor at 9.5%, making virtually all advanced chips, and Broadcom at 8.9%. This is effectively an index of every company making AI physically possible. The details: just 26 companies, low 0.35% expense ratio, tiny 0.3% dividend, and a massive 46.2% year-to-date return. Analysts forecast 19.1% upside. ETF number 6, iShares US Technology ETF, ticker IYW. If SMH is the engine, IYW is the entire vehicle. It captures the full tech ecosystem. Unlike other tech ETFs that exclude Google and Meta by classifying them as communication services, IYW keeps the whole gang together. You get chip designers like NVIDIA and Broadcom alongside the hyperscalers like Amazon, Microsoft, Apple, Google, and Meta. These are the companies actually architecting AI systems. It's heavily concentrated with winners while giving you critical exposure to the entire software and hardware stack. The details: 142 companies, 0.38% expense ratio, 0.14% dividend, and a solid 24.6% year-to-date return. Analysts see 23.6% upside. Layer 4, the accelerator, quantum. As silicon starts hitting its limits, quantum computing enters as the turbocharger. It's not replacing classical computers, it's multiplying what they can do. This sector is projected to hit $1 trillion by 2035. ETF number 7, Defiance Quantum ETF, ticker QTUM. QTUM is unique because it doesn't force you to pick a single winner in a volatile industry. Instead, it buys the entire quantum ecosystem, hardware, software, and infrastructure together. You get pure-play quantum builders like Rigetti Computing, balanced with diversified semiconductor giants like Micron and AMD. It's one of the best ways to get exposure to next-generation computing without taking on single-stock risk. The details: 78 companies, 0.4% expense ratio, 0.66% dividend, and a strong 38.2% year-to-date return. Analysts forecast 17.5% upside. Layer 5, the application. Finally, we reach the top of the stack where intelligence enters the physical world. This is about orchestrating entire fleets of robots and autonomous systems. ETF number 8, ARC Autonomous Technology and Robotics ETF, ticker RKQ. RKQ focuses on autonomy and orchestration. Unlike other robotics funds that just buy industrial manufacturers, RKQ bets on the brains driving the machines. It targets companies turning physical hardware into intelligent fleets. It's aggressively concentrated on active intelligence. Tesla at over 12%, betting on the autonomous robo-taxi fleet. Teradyne at 10% for industrial automation. Kratos Defense for unmanned defense drones. And they also hold Palantir, reinforcing the thesis that software orchestration is just as valuable as the robot itself. The details: 38 holdings, 0.75% expense ratio, no dividend, and it's the top performer in this category with a 48.3% year-to-date return. Analysts see 18.9% upside. My allocation strategy. Now for the fun part. How would I allocate $100 into this AI industrial stack? I'm not following traditional balanced rules here. I'm investing based on where the constraints and cash flows are right now. I call it the Bottleneck and Brains strategy. 40% to the engine room. This is where cash flow is today. You can't underweight a sector growing at 40% per year, 25% into SMH. This is my highest conviction hold. Chips are the new oil of the 21st century. I want pure, concentrated exposure. 15% into IYW. This is my safety net, giving me the hyperscalers. Google, Microsoft, Amazon. These companies are rich enough to buy all those chips. I want to own both the seller and the buyer. 30% to the physical constraint. I'm overweighting this because the energy bottleneck is happening right now, not in 10 years. 10% to URA. Pure commodity exposure. When the supply crunch hits, miners move fastest. 10% to grid. This is the most underrated trade in the entire stack. Transformers and substations are back-ordered for years. If the grid doesn't work, AI doesn't work. 5% to NUKZ for steady utility contracts. 5% to DTCR. Real estate tends to be slow, so 5% is enough for exposure without dragging down performance. 20% to the application layer. This is visible automation happening right now. Full 20% into ARKQ. Robotics is happening faster than quantum. Tesla's fleets and warehouse automation are deploying today. This deserves more weight than science projects. 10% to the future option. This is the true moonshot. Full 10% into QTUM. Quantum is highest risk, but 10% is a healthy call option size. It's enough to make a fortune when the tech hits, but small enough not to ruin my year if it gets delayed. That's the trade. Heavy on the engines working today, heavy on the energy bottlenecks threatening to stop them all, and just enough on the future to capture the upside when it arrives. If you found this valuable, make sure you're subscribed, because I'll be tracking these positions throughout the year and updating you on performance. And if you want the full breakdown with my detailed research, check the description for my newsletter and spreadsheet. Thanks for watching, and I'll see you in the next one.